Thank you for tuning into KBRA podcasts, where we cover topical research discussions, industry commentary, and more. As KBRA continues to expand globally, KBRA podcasts are a go-to source for intimate briefings directly from our knowledgeable team members. In this episode, Bill Cox, Global Head of Corporate Financial and Government Ratings at KBRA, speaks with Joan Feldbaum-Vidra, KBRA's Head of Sovereign Ratings, about emerging market sovereign credit challenges amid the COVID-19 pandemic. While the crisis is unusual in its breadth across so many emerging market economies, the impact is highly differentiated. Other topics discussed include how China's role, as well as changes in lender behaviors and growing pandemic-related debt burdens, make the COVID-19 economic disruption different than the Latin American debt crisis of the 1980s. Stay tuned to learn more.
Good morning, Joe. I'm excited to talk with you today. It's a great topic. Particularly eager to hear why this crisis for emerging markets is different than past crises. I know you have some pretty strong opinions about that, and I'm looking forward to the history lesson. But before we go there, can you give us a broad update on the current state of affairs in emerging markets just before and now during the COVID-19 crisis?
Sure, Bill. I'm happy to do so. It goes without saying that as an asset class, sovereign credit risk has risen. Sovereigns are really at the center of this storm. They have to use their fiscal powers, their balance sheets to manage the public health crisis and help economies weather the impacts of the lockdown and social distancing. And debt is rising quite quickly, as we've been seeing. And emerging markets, this is important to note, are generally more vulnerable than advanced economy counterparts because they have more limited fiscal space and more limited access to capital. And also, in addition to the shock, the domestic shock on their economies, are also being hit by a layered external shock or several shocks. And these are financial and commercial, those external shocks. So on the one, first, we have capital outflows that have been very extreme, especially in March and April. They've not fully recovered yet, even though they have improved. In addition to that, on the external side, emerging markets are generally very commodity dependent, and they've been faced with energy and commodity price weakness. And when the oil price went negative, that really precipitated crisis conditions in several emerging markets. Then there's also the concentration in tourism. That's particularly detrimental to many emerging markets, although not exclusively. Remittances is another area of external shock. They have been quite buoyant to date. That's often the case whenever there's a crisis in the home country, but the concern is the future and that those flows won't be sustained. So this time is definitely different for the emerging markets as an asset class. There's some positive, but there are also some negative implications on credit as a whole. On the negative side, well, there are a couple of things here. COVID-19 is a symmetrical shock that's facing all economies. And what that means is that the countries in a position to help weaker economies are also being stretched. But on the other hand, no one is to blame from this crisis. It's not a result of economic mismanagement or flawed policies or anything like that. It goes without saying that everyone could have been better prepared for this. That's no question there. But there's also profound humanitarian concerns, and all of these considerations are important to understanding debt risks as well.
Great. Really interesting. So what are some of the characteristics that might be distinguishing some emerging markets from others in terms of their ability to weather the current storm?
So first, it's important to note that emerging markets are not a monochromatic group. They're made up of all different types of economies with all different levels of fiscal flexibility and institutional strength. Some countries in the emerging market space look more institutionally developed than some countries that are classified, and KBRA uses the IMF's definitions here, as advanced economies, advanced industrialized economies. Some emerging markets have vast sovereign wealth funds that are multiple of their near-term debt service needs. Other emerging markets are more like frontier economies with very limited resources, whether financial or otherwise. And some emerging markets will have greater flexibility to manage the shock of COVID. Some have access to asset purchase programs by their national central banks, similar to what we're doing here in the US with the Fed's programs. Not as extensive, of course, but though that support goes far to assisting the financing needs for those countries, even if not as extensively as in advanced economies.
So, Joan, what does this mean for potential defaults in the sovereign universe? Can you dimension this in terms of size and locations where this may be on the horizon?
Yes, Bill. So I'll remind you that back in March and April, really when things were extremely dire, especially in the US, many prominent economists were discussing blanket bilateral debt relief for poor countries in the emerging markets and frontier market space. And there was a lot of fear that there was going to be a quick and sudden massive onslaught of sovereign defaults, just even entering the lockdown, because, we were all reading the tea leaves there on what was going to happen in terms of the second quarter. But like I said, in contrast to many advanced economies, emerging market economies were not only facing that domestic shock of lockdown and public health demands, but were also importers of external shock. And here, what's also important to note is that emerging markets borrow in foreign currencies. And this can mean that those capital outflows that we saw, or what we also refer to as balance of payments developments, can be very worrisome for them, depending upon the sovereign. This is a concept that this dependence on foreign currency debt has been called the original sin by economists. So why? Because naturally, depreciating currencies will heighten the risk of a credit event, especially when that weakening of the currency is substantial. And then there's also the vulnerability to sudden stops in capital flows. For some countries in the emerging market space, the availability of swap lines, the Fed has opened 2 of these temporarily for 2 emerging markets, that's Brazil and Mexico. Turkey also has one with Qatar, for example. Those types of developments do help liquidity, but they're by no means a solution. So we are concerned that COVID will introduce a possible paradigm shift as this shock is like no other that we've ever witnessed. However, notable that as of today, while many weak economies are indeed seeking to restructure their bilateral debts, those are debts that are government to government. Tunisia, for example, just announced one. To date, there are only 5 countries that are in default or actively seeking restructuring of their sovereign bond debt. These are Venezuela, Argentina, Lebanon, Ecuador, and just Suriname just popped into the mix. The first 3 of those had very, very acute debt problems going into COVID, but the other 2 were thrown into the situation by the pandemic. There are more behind. Zambia, Belize are next to watch, and there's many others that could potentially fall into distress in terms of their bond debt. It all depends a lot on economic recovery. And that itself depends upon virus containment and consumer demand in large economies and small economies all over the world, and other behavioral issues related to supply chains and possible continuing deglobalization trends. There are lots of unknowns here, and it's hard to know the extent of the downside risks or what other black swan events could be in the pipeline. But for sure, if commodity prices rest at a new low level for a durable amount of time, and if tourism is permanently scarred, this will prompt further deterioration in sovereign credit, especially in the emerging market space.
Well, no more black swans, please. I think we've had enough, at least for 2020. So, Joan, do you have anything to tell us that's more positive? I mean, both China and the US have reported some positive economic news recently. Does that bode well for emerging markets? Will there be some trickling down of that positive news, or is there any other positive news on the horizon?
Well, we sure hope so. Both the US and China are very, very essential to global demand. China, for example, is an enormous importer of commodities. At one point, I think half of cement imports in the world went to China. It's really, really a powerhouse. And of course, we know about the American consumer and its role in the global economy. In terms of China, you're right. There was some positive news out of China. The recent second quarter data was just printed, up 3.2% GDP growth year over year, better than expected. And in fact, the IMF forecasts positive growth for China for the year, which is quite something. So in terms of global demand, the US and China are key here. But there's something else that I want to mention that's very important to the emerging market space and global conditions as well, and that is the risk of China instability. Here, I'm going to give you a bit of a history lesson, so bear with me. China has a very, very high savings rate, and in the early 90s, a lot of that savings was mobilized to finance an export-driven growth model. But once that changed, after the global financial crisis, when trade slowed and export demand slowed, there was a shift and the savings were reoriented. And in China, there's a lot of policy direction, centralized, had been destined more towards internal sources and internal investment. And this increased a very, very large buildup in debt in China. We're talking about an economy now that has debt to GDP of 250%. That's the entire economy. That's a very big number in the emerging market space. And in the past, when we've had such a rapid debt buildup, we've had crises. So there are many examples of that. You can think about the United States before the global financial crisis. You can think about the European debt crisis and what those debt statistics look like in the periphery, the Asian financial crisis, a lot of short-term debt in that case. The Russian financial crisis, that's a really interesting one because that was a local currency issue. But at the same time, while there are a lot of risks, it's also important to say, well, China has been quite resilient, but a lot of that resiliency is predicated on the capital controls that are keeping that money inside. That could change, and that's always been that's a risk. And that's something we certainly will be watching. One other thing I want to mention is, actually it's important for the EM space, is China's been building up an awful lot of debt, yes, but also other emerging markets too have been building up a lot of debt. And that is also something that tends to elevate risks.
Got it. There's clearly a lot going on here, Joan. It's all very interesting. Before we get into the history, which I'm still eager to hear about, what's the status of their current debt profiles? I imagine that's a very important feature of ongoing credit monitoring, and I imagine there's differences across the different countries. So give us a sense of where they are right now in terms of differences in the profile of their debt.
That's right. The EM sovereign universe is quite differentiated. Some are very resilient to shocks, some are not. Some will grow out of their increased debt loads, some may not. It's important to mention here that KBRA's approach to looking at these issues really gets to the heart of what you're asking, which is, resiliency. And in our approach to sovereign credit, we're very, very focused on liquidity as a key factor that can drive our credit views. For example, in the advanced world, even though this podcast is about emerging markets, where access to liquidity, affordable liquidity, is very strong, we affirmed all of our ratings to date for all of our surveillances. And that was the extent of our actions in the advanced economy space. But in the emerging markets, the risks are higher, clearly. But also, it's important to note, and I'm going to reflect back on the fact that to date, despite this unprecedented, enormous crisis, we have had a very circumscribed number of defaults. And why is that? Well, on the one hand, sovereign debt is unsecured and sovereigns have immunity that no other debtors enjoy. But on the other hand, they have the best access to all the country's resources. They can ration foreign exchange. They have taxing authority. And they also have access to multilateral and bilateral funds. All of that can help them bridge a crisis. So actually, default rates for high yield sovereigns is much lower than that for US high yield corporates. That's interesting. And while I've mentioned that emerging markets have increased their debt load since the global financial crisis, low interest rate environment tells you a lot about why. But as far as the government sector is concerned, it's also important to note that many emerging market sovereigns have actually shifted their debt management strategies and have been able to borrow more in local currency, again, trying to avoid that original sin that we discussed earlier. And this does make them less exposed to exchange rate risk, which does help their external vulnerability. But those sovereigns with large non-resident holdings of their local currency debt still remain exposed to sudden shifts in investor sentiment and hot money flows. So we are looking at that very closely in our analysis. And lastly, I just want to underscore the sea change that I mentioned earlier in the flexibility of monetary policy. We're in uncharted waters now where emerging markets are able to have their central banks support the increases in fiscal debt. And also rock bottom interest rates by the Fed has enabled emerging markets to follow suit and cut rates. And that goes quite far to helping those economies and their debt profiles.
So, Joan, another thing that is very different today versus then, I would imagine, is with regard to who the lenders are. Tell us more about that.
So in the 80s, during the Latin American debt crisis, the creditors were primarily commercial banks. And those commercial banks, of course, are systemically important institutions to an economy, as compared to now when there's so much more bond financing. So the creditor profile was very concentrated and the creditors were systemically important. And that's a big difference. What that means is that governments could be involved here and had to be involved here in a very compelling way. And they helped coordinate the debt relief initiatives in the debt restructuring initiatives in those debtor countries through regulatory influence over commercial bank creditors and through political influence over the debtor countries.
Got it. So what are some of the other differences with regard to the creditor profiles compared to the Latin American debt crisis of the 80s?
So right now, while the creditor profile in the 80s was very concentrated in commercial banks, right now it's much more disparate and vast, comprising bond creditors, bilateral creditors, and multilateral creditors. And so persuasion by the government doesn't really play a role here. And it's much more difficult to get everybody around the table, if at all possible. But what is different here right now is a lot of the foreign currency debt is written with collective action clauses in the sovereign bond documentation. That could help facilitate debt restructuring and perhaps also help improve longer term debt sustainability post-debt restructuring. That was a shortfall in the 1980s. The restructurings really didn't put those countries on a path of debt sustainability. So as a result, there was an era of repeated restructurings for those countries.
So are we witnessing some of that right now with respect to the poorest countries? The debt service suspension initiative, for example, that seems to be a coordinated effort.
Yes, it is. So the debt service suspension initiative is limited. But first, let me explain what exactly that is. As I noted earlier, back in April, the G20 group of governments, note, not the G7, the G20, the world has changed a lot. The finance ministers of the G20 responded to all the calls by the World Bank and the IMF to grant debt service suspension relief to the poorest countries to help them manage the severe impact of COVID. So remember, these countries have limited resources. So they're really caught between deciding on paying their debt and helping fund public health initiatives. So some key issues to follow here are the fact that this is only bilateral debt and also that these countries will still owe that debt. It's just deferring when they need to pay the debt. So how the structure of this is working is that they will have a 1-year grace period, and then they'll have to pay the deferred principal and interest over the next 3 years. What that means is if you look at a year and then they're going to have more debt to service over the medium term. And these are fragile economies. And remember, we don't know what the growth outlook will look like or what will happen to commodity prices. The other thing I want to mention here is that this is only bilateral debt again. It doesn't include commercial bank or bond debt, which is known as private debt, or multilateral development bank debt. On the private debt, there's no explicit what's called private sector involvement or PSI. This is an acronym we were all throwing around during the Greek debt restructuring. And another thing to note here is that China's role is really, really important. It is one of the biggest creditors to the poorest countries in the world. Some of that relates to the Belt and Road Initiative, the massive expansion of the commercial web, that it's infrastructure web covering the globe. That itself is a huge challenge to Pax Americana. That's another topic we can explore in a future podcast. But we don't know a lot about this debt because it's bilateral. There's no documentation. Now, there's been some progress by Johns Hopkins. They did a study on this. So we do know a little bit more, but the terms of these the structure of this bilateral debt, and the quantity is quite murky. What we do know is that it's been pretty expensive. Oftentimes, bilateral debt is given with a very big aid component. This debt has not been. It's been very, very difficult to service. Even before COVID, for example, Sri Lanka was having problems paying for its debt, bilateral debt to China. There are lots of evidence of this, but China is a big piece of this puzzle.
Really interesting. That's a major change since the 80s. Obviously, changes the whole landscape. With regard to some of the temporary relief initiatives, help us understand how these may impact the prospects for bond default in the short run, and what is the role for multilateral development banks here?
Good question. So again, the DSSI covers only bilateral debt, but that's only a portion of the debt. A lot of the debt that's been procured by the weakest countries in the world is multilateral or also private creditor debt. I think in Africa, about half of the debt is from private creditors, and that's not being discussed. That would trigger restructuring that debt, bond debt would be a credit event, of course. Now, with regards to the multilateral development banks and their exposures, so the multilateral development banks enjoy what's called preferred creditor status. And they're a really big part of the financial architecture that helps weak economies. So that's being avoided as well, restructuring those debts. Now, if that should change, that would change the risk profile of those institutions for sure. But restructuring private debt and multilateral debt would also totally change the availability of cheaper financing for these countries in the future. Not that private debt is at all inexpensive, but if there were to be credit events, the cost would go up precipitously.
Well, you have a lot to keep your eyes on. Obviously, there is a lot of dynamism in the sovereign credit universe these days. Anything else you can tell us that we should be thinking about?
The last things that I think I just want to mention is, with this very big buildup in debt that's going on because of COVID, it also increases what's called the doom loop risk, because banks can potentially be having a larger exposure to the government. And obviously they could be having problems because of the situation and the condition and the economies. So that's another thing we look at, the nexus between the sovereign and the banks. And then one other item that's important to think about is the interest rate environment. You've seen in the sovereign space, especially in the emerging market space, a very large increase in borrowing in 2020. This is something that we've seen in a lot of credit markets. Financing is really cheap. It's opportunistic to take advantage of this. And certainly negative rates in Europe and Japan and the ultra low interest rates in the US have definitely been a very big part of that story. So emerging markets are borrowing a lot more in foreign currency at the sovereign level. So I talked before about how they were increasing their local currency share of their profile. Now that this is slightly changing. But what the risk here is that they're building up their external debt, their foreign currency debt. And then when interest rates move, perhaps that search for yield won't be as attractive. So that's something to look at, and we're watching how they manage their rising debt loads.
Well, thank you, Joan. That is a fascinating story and lots to keep us busy over the next few months, it seems. Thanks for sharing all of that.
My pleasure.
This concludes today's episode. Feel free to continue the conversation on LinkedIn and Twitter @CrowBondRating. We would like to also remind you that our research and rating reports are complimentary at KBRA.com. Lastly, if you have any ideas for future podcasts or would like to share your feedback with us, please email media@KBRA.com. See you next time.